Every financial publication in the country will tell you where to buy real estate. Best cities for investment. Hottest markets of the year. Top 10 places to build wealth through homeownership. These lists flood the internet every quarter, backed by cherry-picked data and sponsored by the very real estate industry that profits from every transaction regardless of whether you make money or lose it. But almost nobody publishes the list that actually protects your wealth. The places where you should categorically not buy right now. The markets where deploying capital into residential real estate in the current cycle is not investing. It is speculation without a thesis. And in an environment where home prices are still elevated, mortgage rates are still painful, and the margin for error on a bad purchase has never been thinner, knowing where not to buy is worth considerably more than another breathless recommendation of the next hot market. Here is the uncomfortable truth that the real estate industry will never say out loud. A 20% loss on a $400,000 home is $80,000 of destroyed equity. No amount of appreciation in another market can compensate for that kind of capital destruction. Avoiding the wrong market is the highest ROI decision you can make right now. What we are building today is a ranked assessment of the worst states to deploy capital into residential real estate at this specific moment in the cycle. It is grounded in 5 measurable metrics that sophisticated investors use to evaluate market risk. The all-in cost of ownership, which is your mortgage plus taxes plus insurance combined. The inventory trajectory, meaning whether supply is rising or falling. The income-to-price ratio, which tells you whether local wages actually support current valuations. The fiscal health of the state, including debt levels, pension obligations, and structural deficits. And the migration vector, which tracks whether people are moving in or quietly leaving. When all 5 of these metrics are flashing warning signals simultaneously, you are looking at a market that is either in active correction or building toward one. And right now, more American states are showing that 5 alarm signal than at any point in the past 15 years. The surprise state. There is one state on this list that will genuinely surprise you. It is currently one of the most popular migration destinations in the country. Millions of people are still moving there. Real estate agents are still pitching it as a growth story. And yet the data, when you look at all 5 metrics together rather than cherry-picking the favorable ones, suggests it may be the single worst place to commit capital right now. I will show you exactly which state and why before this breakdown is finished. But first you need to understand the framework that separates a market with temporary headwinds from one with structural deterioration. Because that distinction is everything when it comes to protecting your equity position in the current cycle. The framework. 5 metrics that reveal true market risk. Most homebuyers evaluate a market by looking at median price trends and days on market. These are lagging indicators. They tell you where the market has been, not where it is going. The 5-metric framework we are using today is built around leading indicators, the signals that appear before price movement becomes visible in the headline data. The all-in cost of ownership is the most frequently underestimated metric. Buyers focus on the purchase price and the mortgage payment. They overlook property taxes, homeowners insurance, HOA fees, flood insurance, special assessments, and the cost of deferred maintenance on aging housing stock. In several of the states on this list, the non-mortgage carrying costs have grown so dramatically that they have effectively eliminated the financial rationale for owning over renting. Stop and consider this. In some markets right now, the monthly cost of ownership when you include all carrying costs exceeds the monthly cost of renting an equivalent property by $400 to $600. You are paying a premium to own an asset whose value is under pressure. That is not wealth building. That is wealth destruction with extra steps. The inventory trajectory metric tells you where supply pressure is building before it shows up in price. Markets where new listings are outpacing absorption, where months of supply are rising, and where builder incentive programs are masking true price concessions are markets where the published median price is telling you a more optimistic story than the underlying transaction data supports. The income-to-price ratio is the structural affordability check. When the median home price in a market exceeds 5 times the median household income, affordability stress begins limiting the buyer pool. When it exceeds 7 times, the market is functionally dependent on external capital, investors, equity transfers from other markets, and high-income transplants, rather than organic local demand. Markets dependent on external capital are vulnerable the moment that external capital finds a better opportunity elsewhere. With the framework established, Let us get into the specific states where these metrics are most deeply in the red right now. We are starting with the states where the problems are real but relatively contained, and building toward the markets where the risk convergence is most severe and most urgent. State number 7, Illinois. The fiscal death spiral. Illinois is the state that most experienced investors already avoid, but usually for reasons that dramatically undersell the severity of the problem. The standard complaint is high property taxes. That is accurate but incomplete. The deeper issue is what is driving those taxes higher and why there is no realistic mechanism to reverse the trend. Illinois is caught in what economists call a fiscal death spiral. The state carries one of the largest unfunded pension liabilities in the nation, with estimates consistently placing the total obligation above $200 billion when measured on a market value basis. This is not an accounting abstraction. The Illinois Supreme Court has ruled that pension benefits are constitutionally protected and cannot be reduced. The obligation is real, it is growing, and it must ultimately be paid by the residents who remain in the state. Here is something most people completely overlook. When you divide Illinois' total unfunded liabilities across the household population, the hidden per-household debt burden rivals a second mortgage on many properties. Most homebuyers never factor this into their purchase decision. They buy a house. They are also buying a share of a fiscal disaster. The population data tells the story of how this plays out over time. Illinois has experienced consistent net outmigration for years, with the Chicago metro losing residents to Indiana, Wisconsin, Tennessee, and Florida. Every household that leaves takes its tax contribution with it. The remaining population shoulders a larger share of the fixed pension obligation. Property taxes rise to compensate. More residents leave. The cycle continues. For homeowners in Illinois, this dynamic has a direct and measurable effect on property values. Markets where tax burdens are rising faster than incomes face a structural compression of what buyers are willing and able to pay. The capitalization rate on after-tax housing costs moves against existing owners regardless of what is happening to property values in adjacent states. The one nuance worth acknowledging is that Chicago's core neighborhoods and specific suburban corridors have maintained demand despite these headwinds. But the structural fiscal pressure applies statewide, and the trajectory is not improving. As we move through these states, notice that the pattern repeating itself is not about surface-level price data. It is about hidden costs accumulating beneath an apparently stable price surface until the weight becomes impossible to ignore. Illinois does it through pension-driven property taxes. The next state does it through something that buyers discover only after they have already closed. State number 6, Louisiana. The all-in cost illusion. Louisiana consistently appears on lists of the most affordable housing markets in America. Median home prices are a fraction of the national average. For buyers priced out of coastal markets or Sun Belt metros, it looks like genuine value. It is not. It is one of the most misleading value propositions in the current market. The affordable sticker price in Louisiana conceals an all-in ownership cost that, when fully calculated, rivals states with median home prices twice as high. The primary driver is insurance. Louisiana's geographic exposure to hurricanes, flooding, and subsidence has made it one of the most expensive states in the country to insure a home. Flood insurance through the National Flood Insurance Program is mandatory for properties in designated flood zones, which covers vast portions of the state, and can add several $1,000s to the annual cost of ownership before the standard homeowner's policy is even purchased. You might think that Louisiana's low purchase price makes it a value play for yield-focused investors. But the reality is this. A property generating a parent gross yield of 9% can see that yield compressed to 3% or below once insurance, vacancy reserves, property management, and maintenance on aging housing stock in a subtropical climate are factored in. 3% net yield in a market with negative migration is not an investment. It is a cash flow trap. The economic fundamentals compound the risk. Louisiana's economy remains heavily concentrated in energy extraction and petrochemical manufacturing, both of which are cyclical and facing structural headwinds from the long-term transition in energy markets. Population outflow has been consistent and is concentrated among younger, educated workers, which are precisely the demographic that sustains housing demand over time. Infrastructure quality adds another layer of hidden cost. Louisiana roads consistently rank among the worst in the nation by condition metrics, and deferred infrastructure investment is a direct drag on surrounding property values. When the physical environment surrounding an asset deteriorates, the asset deteriorates with it regardless of what is happening to its official appraised value. State number 5. New York. The regulatory squeeze. New York's inclusion on this list surprises no one. But the specific mechanism destroying value in the current cycle goes considerably deeper than the standard complaints about high taxes and expensive living. The most acute risk for property investors in New York is what we can accurately describe as the regulatory squeeze. The state has implemented among the most aggressive tenant protection frameworks in the country. Rent stabilization laws cap how much landlords can increase rents on covered units, often limiting increases to single-digit percentages annually. At the same time, operating costs including insurance, utilities, labor for maintenance, and compliance requirements are rising at rates that frequently exceed those capped increases. Here is something most people completely overlook. The mathematical result of capped revenue and uncapped expenses is not gradual compression. It is a slow-motion solvency crisis. Buildings that were generating positive cash flow 5 years ago are now operating at break-even or below. Owners who cannot sustain the negative carry are being forced to sell into a buyer pool that is fully aware of the operating constraints they are inheriting. For individual home buyers rather than investors, the risk takes a different form. New York's combined tax burden, property taxes among the highest in the nation plus state income tax plus city income tax for New York City residents, creates an all-in cost of ownership that is among the most punishing in any American market. The commercial real estate contagion adds a forward risk that most residential buyers are not currently pricing in. Office vacancy rates in Manhattan have reached historically elevated levels, with some estimates placing them above 30% when shadow vacancy in underutilized leased space is included. As commercial property valuations decline, the city's tax base erodes. The structural pressure to shift more of the tax burden onto residential property owners is real, and the direction of travel is not favorable. The migration data is the clearest signal. New York has been losing high-income residents to Florida, Texas, Tennessee, and the Carolinas for several consecutive years. Each departure removes purchasing power and tax contribution from the market simultaneously. Illinois, Louisiana, and New York each have a dominant vulnerability: fiscal deterioration, hidden carrying costs, and regulatory suffocation, respectively. But the states we are moving into now are the ones where multiple vulnerabilities are converging simultaneously. And convergence is what turns a market correction into something considerably more durable and more damaging. Mississippi presents the most seductive trap on this entire list because it looks, on every surface-level metric, like the kind of value opportunity that disciplined investors dream about. Low entry prices. Apparently high gross yields. Minimal competition from institutional buyers who consider the market too small to bother with. The problem is that cheap assets in economically stagnant markets are not undervalued. They are accurately valued. And the distinction between undervaluation and accurate valuation is the most important analytical judgment any investor makes. Stop and ask yourself this question before buying in any low-cost market. Is this asset cheap because it is temporarily undervalued and the market will eventually recognize that gap? Or is it cheap because the structural demand drivers that would create appreciation simply do not exist here? In Mississippi, the evidence consistently points toward the second explanation. Mississippi has the lowest median household income in the nation. Population growth is negative. The working-age population has been declining for years as younger residents relocate to markets with stronger employment prospects. GDP growth consistently trails the national average, and the industries that anchor the economy, agriculture, manufacturing, and federal military installations, are either low growth or subject to federal budget decisions outside any local control. For yield-focused investors, the gross numbers look compelling until the operational reality is applied. Tenant pools in low-income markets carry higher default risk, higher vacancy rates, and higher turnover costs. Maintenance expenses on aging housing stock, much of which was built before modern construction standards, tend to be disproportionately high relative to asset value. And insurance costs in the southern portion of the state, exposed to hurricane and tornado risk, have been rising sharply in the current cycle as insurers reprice climate exposure nationally. The demographic trajectory is the most durable headwind. Housing appreciation over a full market cycle is ultimately driven by population growth and income growth. Mississippi shows neither. Equity in a market with no appreciation engine is dead capital, generating yield that compensates inadequately for the operational complexity and risk it requires. State number 3, Florida, the surprise state revealed. This is the state I referenced at the very beginning of this breakdown. Florida, the promised land of zero state income tax, year-round sunshine, and the retirement dream that an entire generation of Americans has been sold for decades. The state that has attracted net domestic migration consistently and still appears on virtually every mainstream list of desirable real estate markets. Here is what most people completely overlook about Florida right now. Popularity and value are not the same thing. A market can be simultaneously the most popular migration destination in the country and one of the worst places to commit capital. Florida is currently both of those things at once. And the mechanism that makes it dangerous is hiding inside a number that most buyers never see before they close. This is what I was pointing toward earlier when I mentioned the surprise state. The first force destroying Florida's value proposition is the insurance crisis, and it is more severe than most national coverage suggests. Multiple major private insurers have either stopped writing new homeowners policies in Florida or have withdrawn from the state entirely. The state-backed Citizens Property Insurance, originally designed as the insurer of last resort for properties that could not obtain private coverage, has become the primary or only option for a growing share of Florida homeowners. Citizens is not financially equipped to serve as the dominant insurer for the largest hurricane-exposed state in the country. The practical consequence for buyers is that annual homeowners insurance premiums in Florida now average significantly above the national norm, with coastal and flood zone properties paying multiples of that average. When property taxes are added to insurance costs, the monthly non-mortgage carrying cost of a Florida home can exceed $1,000 before a single mortgage payment is made. The zero-income tax arbitrage that justified relocating to Florida has been substantially or entirely consumed by this carrying cost reality. This is the hidden cost pattern I flagged earlier in the breakdown. The all-in cost illusion. Louisiana hides it in flood insurance. Florida hides it in homeowners insurance and property taxes. The sticker price looks manageable. The full ownership cost does not. The second force is the condo market structural crisis. Following the Champlain Towers collapse, Florida enacted legislation requiring stricter structural inspections and fully funded reserve accounts for condominium buildings meeting specific age and height thresholds. The intent was correct. The financial consequence for existing condo owners has been severe. Buildings are issuing special assessments to fund required structural work and reserve replenishment. These assessments range from tens of thousands to, in the most extreme cases, over $100,000 per unit. Owners on fixed incomes, which describes a significant share of Florida's condo-owning population, cannot absorb assessments of this magnitude. The result is a wave of distressed condo listings hitting the market simultaneously, concentrated in older buildings in precisely the coastal locations that command premium prices. Buyers reviewing association financials before closing are frequently walking away from deals rather than inheriting an unknown future assessment liability. Transactions are collapsing. Values in affected buildings are declining. The third force is migration normalization. The exceptional net inflow of domestic migrants that defined Florida during the pandemic era has moderated meaningfully. The financial calculus that drove that migration, primarily the income tax savings and relative housing affordability compared to origin states, has been substantially eroded by rising insurance, rising property taxes, and a housing price level that appreciated dramatically during the boom years. The population growth engine that justified the Florida investment thesis is running at a fraction of its peak velocity. State number 2, Texas. The oversupply reckoning. Texas was the other invincible market. No state income tax. Explosive corporate relocation-driven job growth. A builder-friendly regulatory environment that allowed supply to respond to demand faster than almost any other major market in the country. For a sustained period, the Texas thesis was not speculative. It was grounded in genuine fundamentals. That is what makes the current correction both more credible and more dangerous than a purely speculative boom would produce. Here is a data point that should reframe how every Texas buyer is thinking about this market right now. Texas has added more new housing units in the current cycle than any other state in the nation. The construction pipeline delivered tens of thousands of new homes and apartment units into major metros at precisely the moment when the corporate relocation wave that was supposed to fill them began moderating. The supply kept coming after the demand signal weakened. That is the structural definition of oversupply. The oversupply correction is most advanced in Austin, where the tech sector contraction reduced the high-income renter and buyer pool that the market was built to serve. But Dallas, San Antonio, and Houston are following the same trajectory at different points in the correction cycle. Builders are offering incentive packages worth $30,000 to $50,000 per transaction, including mortgage rate buydowns, upgrade packages, and closing cost credits. These incentives do not appear as price reductions in median home price data. They are what analysts call shadow discounting. The published price looks stable. The effective purchase price after concessions is considerably lower. Texas property taxes compound the affordability problem in a way that the no-income tax narrative consistently obscures. Effective property tax rates of 2 to nearly 3% in many Texas counties mean that a $400,000 home carries $8,000 to $12,000 in annual property taxes. Combined with insurance premiums that have risen sharply due to hail, tornado, and flooding exposure, the monthly all-in carrying cost of Texas home ownership rivals states with significantly higher purchase prices. Into the final state. Texas and Florida each have one dominant vulnerability compounded by several secondary ones. Oversupply meeting moderating demand in Texas. Insurance crisis meeting slowing migration in Florida. But the number one state on this list is not defined by one dominant vulnerability or even two. It is defined by all 5 of our risk metrics flashing red simultaneously. And that convergence creates a risk profile unlike anything else in the American housing market right now. State number 1, California. All 5 metrics in the red. California is the most complex and, in the current cycle, the most structurally dangerous real estate market in America. The complexity is important to acknowledge up front because California is not uniformly bad in the way that Mississippi or Louisiana present relatively uniform risk profiles. California contains genuine pockets of durable value, established supply-constrained neighborhoods with high income density and generational ownership patterns that resist cyclical pressure. But at the state level, the convergence of 5 simultaneous structural problems creates a risk environment that no amount of local market nuance can fully neutralize for the average buyer. Here is something most people completely overlook about California. The state has experienced sustained net domestic outmigration for several consecutive years, with departing residents having significantly higher average incomes than those who remain. This is not random population churn. It is a systematic loss of the high-earning cohort that sustains California's tax base, its housing demand, and its economic vitality. When the highest-earning residents leave faster than they can be replaced, the financial architecture of the state shifts in ways that affect every property owner who remains. The 5 converging crises. The first crisis is affordability at a scale that has no precedent in California's modern history. At current home prices and mortgage rates, the monthly payment on a median-priced California home requires a household income that fewer than 20% of the state's residents actually earn. This is not a market that is expensive but functional for most participants. It is a market that has mathematically excluded the vast majority of its own population from ownership, creating a buyer pool that is structurally thin and dependent on equity transfers from prior appreciation rather than income-driven demand. The second crisis is the fiscal and tax pressure that is accelerating the outmigration of high earners. California's top marginal state income tax rate is the highest in the nation. For high-income earners, the combined state and federal burden creates a powerful financial incentive to establish domicile elsewhere. Remote work has made acting on that incentive considerably easier than it was a decade ago. The departing residents are not low-income households with limited mobility. They are the business owners, executives, and high-earning professionals whose presence anchors the local economy and whose property tax payments and income tax contributions fund state services. Every departure tightens the fiscal equation for those who remain. Stop and consider the feedback loop this creates. High earners leave to reduce their tax burden. The state's tax revenue declines. Remaining residents face pressure to absorb a larger share of fixed state expenditures. That pressure manifests as upward pressure on taxes and fees across multiple categories, which creates additional incentive for the next cohort of high earners to evaluate their options. This is the same fiscal death spiral we identified in Illinois, operating at a scale that makes Illinois look manageable by comparison. The third crisis is the insurance market withdrawal. Following consecutive years of historically severe wildfire events, multiple major private insurers have stopped writing new homeowners policies in California or have withdrawn entirely. The state's FAIR Plan, its insurer of last resort, has seen its exposure grow to levels that raise legitimate questions about its capacity to pay claims following a major catastrophic event. Properties in fire-prone zones, which covers substantial portions of suburban and exurban California, face a combination of limited insurance availability, rising premium costs, and potential lender refusal to approve mortgages on inadequately insured properties. The fourth crisis is the regulatory environment for property owners and landlords. California has implemented among the most comprehensive tenant protection frameworks in the country, including statewide rent increase limitations, extensive just-cause eviction requirements, and detailed habitability standards. The compliance cost is high, the legal risk of procedural errors is substantial, and the operational environment for rental property owners has become sufficiently complex that institutional capital is increasingly directing itself toward less restrictive markets. The fifth crisis is the commercial real estate contagion radiating outward from San Francisco. Office vacancy in San Francisco has reached levels that represent a generational structural shift rather than a cyclical correction. The tech sector's adoption of hybrid and remote work policies has permanently reduced the square footage of office space required relative to pre-pandemic headcount. Commercial property values have declined substantially from peak levels. The resulting erosion of the commercial tax base creates fiscal pressure that will ultimately flow through to residential property owners in the form of increased municipal costs and reduced services. The 5-metric framework, applied to your market. Now that we have worked through the 7 states in detail, let us return to the 5-metric framework and make it operational for your specific situation. Because the most important application of everything in this breakdown is not knowing that California or Florida or Illinois are risky in the abstract. It is knowing how to evaluate the specific market and specific asset you are considering right now. Here is the test every buyer should run before committing capital in the current cycle. Calculate your true all-in monthly cost of ownership, including mortgage principal and interest, property taxes at the current effective rate, homeowners insurance at current quoted rates, any HOA or special assessment exposure, and a maintenance reserve of 1% of property value annually. Compare that number to the monthly cost of renting an equivalent property in the same market. If the ownership premium exceeds $300 per month, you are paying significantly for the privilege of owning an asset whose appreciation potential needs to be rigorously justified. The inventory trajectory check requires looking at months of supply data for your specific submarket, not the metro average. Metro averages mask enormous variation between asset classes and neighborhoods. A market with 3 months of supply overall may have 8 months of supply in the specific price tier and property type you are evaluating. Rising months of supply is the clearest leading indicator of price pressure that has not yet materialized in median price data. The income-to-price ratio check requires honesty about the local buyer pool. If the median home price in your target market exceeds 5 times the median household income, the market is structurally dependent on buyers earning well above median income. Ask yourself honestly whether the employment base in that market is growing, stable, or contracting among the high-income cohort that sustains above-median home prices. If the answer is contracting, you are buying into a market where the natural buyer pool is narrowing. What to do if you already own in one of these states? This question deserves a direct answer because a significant share of the audience watching this breakdown is not evaluating a future purchase. They are sitting on equity in one of these markets right now and trying to determine whether to hold, optimize, or exit. The answer is not uniform, and it should not be driven by alarm. Several of the states on this list contain specific submarkets and specific asset types that are meaningfully insulated from the broader state-level risk. A well-located, well-maintained single-family property in a supply-constrained neighborhood with strong local employment density in a city like Austin or Miami is a fundamentally different risk profile than a condo in an older Florida building facing special assessment exposure or a multi-unit rental in an Illinois suburb where property taxes are consuming an increasing share of gross rental income. The question every current owner in a risk-flagged market should be asking is not whether to panic. It is whether their specific asset's risk profile has changed materially in the current cycle and whether their liquidity position is adequate to hold through a period of price pressure without being forced into a distressed exit. Forced selling at the wrong point in the cycle is how wealth is destroyed. Patient, Informed holding with adequate liquidity is how it is preserved. If you are holding with a low-rate mortgage in a supply-constrained submarket with strong employment fundamentals, your position is considerably more defensible than the state-level headlines suggest. The lock-in trap that is freezing the broader market is actually protecting your asset by keeping equivalent properties off the market and maintaining scarcity value. If you are holding in a market where all 5 of our risk metrics are deteriorating simultaneously, where your net rental yield is compressing, where your insurance costs are rising faster than your rental income, and where your liquidity reserves are thin relative to your monthly carrying costs, the calculus is different. The time to make a deliberate, planned exit is before the market forces an unplanned one. A 5% concession today on a voluntary sale beats a 15% loss next year on a forced one. The final framework: where capital should go instead. Every market removed from consideration points capital toward a better alternative. The states and markets showing the strongest combination of our 5 positive metrics in the current cycle are not the ones generating the most media coverage. They are the ones with positive net migration, fiscal balance, moderate insurance costs, supply constraints relative to demand, and income-to-price ratios that reflect genuine local affordability rather than external capital dependence. The secondary markets across the Carolinas, Tennessee, and parts of the Mountain West that avoided the most extreme construction pipeline overbuilding of the previous cycle are showing precisely these characteristics. They are not exciting. They do not generate breathless coverage. But in a market environment defined by elevated risk in the highest profile states, boring fundamentals are the most valuable kind. Here is the final truth that ties this entire breakdown together. The worst time to discover you bought in the wrong state is when you need to sell. The research you do before deploying capital is the cheapest insurance you will ever purchase. Every hour spent on rigorous pre-purchase analysis is worth thousands of dollars of avoided loss. In the current cycle, with margins for error thinner than they have been in over a decade, that has never been more true. The states on this list are not necessarily bad places to live. Many of them are culturally rich, economically significant, and personally meaningful to millions of people who have built their lives there. But personal attachment and financial prudence are separate calculations. You can love a place and still recognize that the current moment is not the right one to commit long-term capital to its real estate market. The market does not reward loyalty. It rewards analysis. And the analysis, when applied honestly across all 5 metrics, tells a clear story about where the risk is concentrated in the current cycle and where it is not. The buyers who come through this cycle with their equity intact and their financial position strengthened will be the ones who asked the hard questions before they committed. Not after.